to show you on how to answer final exam question December 2019 on published account. Okay, so if you look at the question, the standard of the publish is always to ask you to prepare SOPL and other comprehensive income, statement of changes in equity, SOCI, SOP, and notes to the company, notes to the account. And for this question, it requires you to prepare notes on the PPE and contingent liability or capital commitment. Okay, so first of all, when you start with the published question, you always look at the additional information, okay, and pass the journal entry so that it will help you to prepare the published account in much easier way and to achieve that balance figure. Alright, so first thing ialah you identify when is the year end of the financial, which is Gold Berhad. Okay, you can find it in the first paragraph of the question. Gold Berhad manufactures and sells machinery. The financial year end of gold ends on 30th June each year. The director authorized the financial statement for issue on 1st October and provided below is the trial balance as at 30th June 19. So when the TB is at the end, is for the year ended 30th June 19, okay, it means that the opening date for the current year is 1st July 18. Alright, why the question tell you about the date when the director authorized the financial statement is because maybe in the additional information there is an event after the reporting date. You have learned this topic before this, and event after reporting date can be either adjusting or non-adjusting event. So only adjusting event will have the journal entry, whereas the non-adjusting event will only be a disclosure in the notes to the account. So for this question, the financial statement is authorized for issue on 1st October. That means any event that happened on 1st July 19 until 30th September 19, so that would be considered as event after reporting date. Alright, and if it is event after reporting date, you have to identify whether it's adjusting or non-adjusting. Okay, first additional information, the revenue figure above includes a credit sale amounting to 1.68 million which was delivered on 8 July. So always keep track with your financial period. Okay, so the goods here is delivered on 8 July, which is after you close your account. Alright, so like I mentioned just now, any event that happened after the closing date could be an event after reporting date and either adjusting or non-adjusting. Okay, so for this one, this is adjusting event because the one that you have reported in your financial statement is a credit sale. It means that you have debit the account receivable and you have credit your sales. Alright, but in fact the delivery has not been done during the year. The delivery is done after you close the account. So when you learn under the revenue recognition, company can only recognize revenue when goods are delivered to the customer. So in this case, during the year ended 30th June, you are not entitled for that revenue, meaning that you cannot recognize the revenue. So what happened is you need to reverse the entry that you have done during the year. So if credit sales, like I said just now, the credit sales is debit, account receivable and credit revenue. So you have to reverse it back to cancel it off. So you have to debit revenue and credit trade receivable by that amount, 1.68 million. Okay, so that's the first one. Second, on 15 July 18, so 15 July is during the year, the NRV of the inventory held as at year ended 30th June was valued at 28 million. Okay, you have to remember, this is a very basic. When you value your inventory, it should be at lower of cost and net realizable value. That means you have to choose which one is the lowest. Is it the cost or is it the net realizable value? What is NRV? NRV is the value of the stock when you sell it. So that's the amount that you will realize from the inventory. So in this case, cost as what you can see from the trial balance is to 32 million. Okay, you can get that 32 million from the trial balance. That's the cost. And NRV given in the additional information is 28 million. So you see that NRV is much lower. So what we can see here, closing inventory has been overstated by 4 million. So when closing inventory is overstated, the COGS will be understated because closing inventory is part of the calculation in the COGS where you deduct the closing inventory. So when you deduct a bigger amount, that's why your COGS will become smaller. So to correct this one, when your inventory is overstated, you need to deduct them. So you have to credit your closing inventory by 4 million. When your COGS is understated, that means you have to increase it back. So you have to debit COGS 4 million. Okay, so we're done with that. Number 3, a customer who owed the company 200,000 was declared bankrupt on 1st July 2019. So 1st July 2019 is event after reporting date. Okay, none of the amount was expected to be recovered. Okay, when this is event after reporting date, it's either adjusting or non-adjusting. So for this case, when your trade receivable unable to pay you, which considered as a bad debts, this is considered as adjusting event because the account receivable that you have reported on 30th June here is not correct because you can never receive that 200,000. So that's why we consider this as an adjusting event. So how do you adjust the bad debts? Of course, you will debit your AFITR and your credit trade receivable. Okay, we credit trade receivable because you cannot get that 200,000, so you have to reduce the asset. Okay, trade receivable is your asset, so you have to reduce your asset. And as a cross-ref, you should debit the AFITR. Okay, now for AFITR, I prefer to open a T account. Alright, it's okay if you don't. Alright, AFITR, you can find the balance BD in the trial balance. Okay, the last item in the TB, 1.440. So AFITR is always on the credit side. So I put it balance BD on the credit side, 1.440. Okay, and I always like to prepare T account for trade receivable. So this is asset, the balance BD should be on the debit side. You get 40 million from the trial balance. Okay, so I put this journal entry into the T account. So you debit AFITR here and you credit trade receivable here. Okay, and don't forget we have passed this journal entry before. Credit trade receivable 1680, so I put it inside the account. So I can see the balance CD of the trade receivable is now 38.12 million. Okay, it's okay if you don't open it, open the T account. I just like to open the T account because I can see the movement of the item much easier, especially if you have to calculate the AFITR at the end. For this question, you don't have to calculate because you just deduct, because the question does not tell you about estimation for the year. So you just find the balance CD by deducting the BD and the debit side. Okay, so you get the balance CD. Alright, so we settle with that. Number 4, a long-term loan of okay, what is BND? This is Brunei. Okay, Brunei currency. 6.72 million was taken from the Bank of Brunei on 1st May 19. Alright, we look at the time frame. 1st May 19 fall in this year, okay, before the closing date. So the spot rate on that date was 2.7, equivalent to BND1. So in Brunei currency, it is 6.72 million, but after you have converted to RM times with 2.7, so it is shown in your trial balance as RM 18.144 million. Okay, you can find that 18,144 in the trial balance, long-term loan from Bank of Brunei. Okay, if you want to calculate, you can prove that 6.72 times with 2.7, you will get 18.144 million. Okay, so that is the rate. 2.7 is the rate when the company make the loan. Okay, when you close the account, all right, company need to check what is the closing rate. So on 30th June, the closing rate is given 2.9 RM, 2 ringgit 90 cent for every one BND. So you need to convert that into RM. So you just times RM 2 ringgit 90 cent with 6.72 million, you get RM 19 million 488,000. Okay, 19,488,000. So you see here from this situation, when you borrow the money, you receive 18,144,000. So when you receive this money, you actually increase your liability by that amount, 18 million. Okay, by end of the year, when you close the account, right, based on the exchange rate, your liability on the closing date has increased to 19 million 488. So the difference between 19 million and that 18 million, okay, which is 1.344 million, is considered as a losses. We call it as a foreign currency losses. Why? Because just because you borrow from outside, which is affected by the changes in the currency. Okay, even though when you borrow, the rate is much lower, which is at RM 2 ringgit 70 cent, but when you report in the financial statement, you have to report as at the end of the year. So there's a discrepancy in the exchange rate, and that rate has increased to 2 ringgit 90 cent. Therefore, you have to bear that liability. So increase in liability is not good to you because you need to pay more. Even though when you make the borrowing, it is much lesser. You only get 18,000. But suddenly, when you, at the end of the reporting date, your liability increased to 19 million. So that 1 million is actually a losses to you. So these losses, of course, losses goes into SOPL. So you will debit your SOPL. You debit your SOPL and you will credit your long-term liability because as per the trial balance, your liability is only 18,144,000. By end of the year, it has increased by 1,344,000. So this credit will actually increase your liability, right? Okay, that's number 4. Number 5 is it is the company's policy to depreciate the PPE on a yearly basis at the following rate. Building 3% on cost, so I just times 3% times with the cost from the trial balance for the building. And then depreciation for the plant and machinery is 10% on carrying value. Carrying value means cost less accumulated depreciation. So these figures are took from the trial balance, the cost and the accumulated depreciation. So I get 4480. So these figures will goes into SOPL and in the notes to the PPE. Okay. Alright. And then on 30th June 19, the freehold land was revalued to 136 million. The director decided to incorporate the revalued amount in the books of account. Alright, so at the end of the year, the land is revalued. The fair value is 136 million. The cost from the trial balance is 112 million. So since fair value is more than carrying value, so there you get surplus 24 million. So debit land, credit ARR 24 million. Okay, number 6 is a provision for compensation. During the year ended 30th June, the company was sued by its staff. So the staff claimed for the compensation amounting to 600,000. So the company's lawyer stated that the company would be held liable. So this is a topic that you learn on provision, contingent liability, and contingent asset. So this case fulfill all the 3 recognition criteria as a provision because there is a present obligation. The amount outflow is probable and the amount can be estimated reliably. So that's why it becomes provision. So we'll debit SOPL compensation expenses and you'll credit provision for compensation 600,000. Okay. Alright. Next. Number 7. A provision of 890,000 is to be made for audit fees. So that's why I pass this entry, debit SOPL audit fee and credit provision for audit fee, 890,000. Okay, and then on 1st August 2019, we are still in additional info number 7. On 1st August 19, the company has entered into a contract to purchase a piece of land at a cost of 25 million. Okay. 1st August 19 is even after reporting date, but this is considered as non-adjusting event because it's just a capital commitment. Alright, so you just need to disclose this in the notes to the account. Alright, so done with that. Number 8, okay, on the tax expenses. So given is tax expenses 4.4 million, so of course these tax expenses, it should go into SOPL. And then you have to check, compare with the tax paid, alright, it's given in the trial balance. So you may find tax paid in the trial balance as 3.2 million. So you see that your expenses that charged to you is 4.4, but the company is only paid 3.2 million. So there is shortage of 1.2. That means the company is still owing to the inland revenue. So when you are still owing, so we call it as tax payable. So you don't have to prepare the entry for this one. You just simply write down as tax expense go to SOPL and the tax payable goes into current liability. Okay, what happens if tax expense is 4.4 million but tax paid is more than 4.4 million? That means you have overpaid to the IRB. So when you overpaid, that is actually your asset. So if it is asset, it becomes tax recoverable. Okay, I'm sure you still remember that. Okay, that's the end of the additional information. We will continue in the next session. Thank you.